Portfolio Builder members, welcome to our December 5th trade alert. A lot of news this morning. Nancy Pelosi is going ahead with articles of impeachment. She did not specify for what, although I suspect they'll be revealing that over the next several weeks. We have the December 11th federal FOMC meeting coming out on the 11th where they may change rates. And then on top of that, we have the December 15th tariff deadline, which I think China will drag its feet, knowing that Trump is under tremendous pressure right now. So that's what we have coming up for us. Let me pull up today's trade alerts so we can go over how these work. We're trading the TLT and GDX today. And on the TLT, you can see we have a maximum risk of $175 per contract, or $1.75 per share, which means the most we can lose on this portion of our portfolio from today until next Thursday will be just over 1%. However, on the other side of the coin, if we do get a fear in the market, which I suspect we will, going towards these two critical deadlines, we have the potential to realize a 2% plus, just over 2%, probably about 2.3% total return on the TLT position between now and Thursday. And so to achieve that, we would have to hit 143 on the TLT, which is where we've sold a call option. And on the downside, our maximum risk ends at 138 because we have the long put. Now, a lot of people are always wondering about option assignment. In this case, the only way we would be assigned on the TLT would be if the TLT were to go well above 143, which is pretty far out from here. That's $4 away. So presumably, if we were to skyrocket towards 144 before next Friday, you might find yourself assigned. Now, what would happen? Well, first, you're going to get 143 per share of the TLT you own. So from here, that's a $3.80 profit. You're also going to get to keep the 18 cents you've collected. So that's another profit added to your portfolio. And most likely, your put option will expire worthless. So you did invest 74 cents for the downside protection. So we're going to be able to wrap up $4 of potential profit and then have to give back 75 cents because our put option will expire worthless. So you can see that's how you get to that maximum profit of $3.24. It's just $4 minus that 75 cents. Now, it's highly unlikely that we will be assigned on this trade because we're selling an out-of-the-money call option on the TLT. Now, some people do get confused how the put option protects your portfolio. You won't be assigned to the downside. All that will happen if the TLT were to go lower is the call option which we've sold will lose value. So that means we've collected 18 cents and we'll be able to close out that position with a debit for maybe a penny or two if the TLT were to travel lower. So we're taking a credit on the call option we've sold, and we're paying a debit to close that out later in the future. Now, on the put option, we've purchased the put option. So that put option will go up in value as the TLT travels lower. So this is a bullish trade where we are expecting the TLT to travel higher. And you can see we've paid a lot more for our downside protection than we're collecting on the call option. And that's because we do want the TLT to go up and generate the profit from the underlying asset. So if this trade is a winner, you should expect both the call option we've sold to show a negative loss, and you should see your put option showing a negative loss. Your only profit on the TLT trade today will be from the TLT itself going up in value. And this is our loose option caller where we're very bullish, and that's again because of all the headline risk in the market. Now in GDX, we did a similar trade. Gold is rocketing higher today. When I put this trade on, It was actually a good bit lower. So if you're closing out your trade now, you actually have a bigger profit on GDX than I reported, but you're going to have a little bit different risk-reward ratio than when I put the trade on. Let me just pull up the trade I put on versus yours so we can compare the two. And we'll go over how this can play out in detail. Okay, so when I put this trade on, we were at 27.72, and the maximum risk was 36.50, and the maximum profit was 63.50. So it's moved up slightly. Let's just see. Now we're trading at 27.80, and the maximum risk is $40, while the maximum profit is 60. So that's still very close to the same risk-reward ratio I'm putting on, and I would recommend still getting this trade right now if you're wondering. So in this case, we've sold the 28.50 call option, and that's when GDX is trading at 27.80. So again, we got to learn the math when we're doing these option callers. We've sold the 28.50 call. That means we're short the 28.50 call, and we will give up all profits on GDX after it travels above 28.50. So let's just say gold market spikes between now and Friday, and GDX flies to 30, 35, 40 bucks. Well, the second it goes past 28.50, you're going to miss out on all profits. You're going to get to pick up the 70 cents that there is from current trading price, which is 27.82 to 28.50. And then we're going to be forced to sell our shares at 28.50. So that's okay. That's a 70-cent profit. We're also going to get to keep the 18 cents we collected from selling that call option. So a credit of 18 cents plus the difference in the last trading price when you entered the trade and whichever strike price we've selected. Now, if GDX travels higher, what's going to happen to our long put option? It's probably going to expire worthless. So we're going to give up that 28 cents we purchased for downside protection. So again, in this setup, our maximum return on the GDX position between now and next week is just over 2% total return. Our maximum risk is just over 1%, about 1.25%. So in both of these trade setups, we're standing to make more than we can lose by selling an out-of-the-money call option and purchasing a near-the-money put. So again, I look at selling call options, something like taking candy from a baby. It's a stock speculator who can't afford to purchase the asset. So instead, they're willing to gamble on a risky call option. And out-of-the-money call options rarely return a profit to the buyer. Now in our case, we actually don't mind if the call option buyer makes money. That means we're going to hit the maximum profit in our trade setup. So if you're ever assigned, just know that you're going to get the maximum profit of that trade and end up in cash the next day. Now, a lot of people are wondering what happens if the trade goes against us. You're going to never be assigned in that instance. What's going to happen is we're going to realize a 99% profit on the call option we've sold. We'll only have to buy it back for most likely a penny. And the put option will go up in value every penny that the underlying asset travels lower. And so all you really need to know is the strike price of where you purchase your put is the maximum loss. So the second you hit 138 on the TLT or 27.50 on the GDX, your losses stop at that point because you have one put option for every 100 shares. Now you're not going to be able to get back the premium you paid for that put option, but that's where your losses stop. Now the way it works is you'll sell that put option for a big profit and then roll over into the next trade. So we really don't care if the TLT goes $10, $20, $30 below 138. It doesn't matter. We will get 138 a share minus the option premium we've paid. And it's going to be from selling the put option for a profit. You will not be assigned if either asset travels lower. The only way you end up assigned is if the asset travels well above the call option we've sold. And that means you've hit your maximum profit on the trade. It also means you get to end up in cash, and all you will have is a long put option. So I hope that makes sense to everyone. We have a setup again where we are protecting with a lot of option premium on the put, and we're not trying to be greedy about collecting very much money from the call option right now. And that's because I'm expecting the TLT and GDX to shoot up higher when we get closer and closer to the December 15th China tariff deadline. Now, if China were to sign a deal with the U.S., this would probably be an event that could potentially cause a TLT and GDX to sell off. So that's our biggest risk going into this trade. But the big picture is that the world's in a heap of debt. To pay these debts down, they are forced to slowly lower interest rates and buy bonds from the central bank into the treasury market. And so they're doing this at a rate of $60 billion a month. I'm much more interested in taking bigger risks on the TLT at this point in time than the SPY because the SPY really has limited upside without a phase one trade deal. And if China is going to give Trump a phase one trade deal during the middle of an impeachment inquiry, I'm a little bit skeptical. So we're playing it relatively safe with expensive put options below all four assets, realizing that it's very hard to predict what exactly is going to happen. All we really know is that we have an impeachment moving forward. We have a Fed meeting on the 11th, which could upset the stock market. And we also have a December 15th tariff deadline. So there's a whole lot of risk, and this is one asset you really want to own going into the next 2 weeks. So that's our trade setup for today. Let me just check the live chat, see if we have any questions. Good morning, Ron. How's it going? If you're listening live and have any questions, please let me know. Also, a little announcement. We're going to switch from doing YouTube live streams daily to Zoom webinars daily. It's a little bit better quality, and it also allows me to open you up to chat and ask questions with your microphone. So you'll be getting a daily Zoom link an hour before the webinar, which will go live at the same time you're used to, right at noon Eastern. So again, this is our trade setup. We are bullish on GDX and TLT with these two trade alerts. Our maximum loss on the TLT is about 1%, just a little bit over 1%, maybe 1.2% week over week, and a very similar maximum risk on GDX. So this represents in total 50% of our assets in this portfolio. Now it's been a patient wait for the TLT and GDX to pay off, but I think you're going to see the fireworks starting to light up in the next week or so. Now, where do we stop enjoying profits? Again, after we go above 143 on the TLT, we're going to miss out on any profits, which I would find highly unlikely on that trade. Now, GDX could certainly go well above 28.50, but to finance the put option, I was willing to take a little bit juicier call option on GDX, and will most likely take a little more risk on GDX next week. I actually want the fear to be in the market when I'm taking more risk on GDX, and for the TLT, I want to be ready to jump into the fear before it actually begins. So TLT will go up on a slight amount of fear, whereas GDX really requires a lot of fear. And that's why we're taking a bigger ratio. If we do compare the ratios, you can see I only collected 17 cents on the TLT relative to spending 78 cents on downside protection, which is about a 25% ratio that I'm able to finance my put with the call. On the gold, you can see I'm actually able to finance my downside protection to the tune of over 50%. So I've paid for about 60% of my downside protection on GDX by selling that call option. Okay, so let's take a look at our trade alert here. For those of you who did take the previous trade, let's walk you through how to get out of last week's trade. So you're going to buy to close your 142 call and sell to close your 138.50 put. So that gets you out of last week's trade. If you didn't take last week's trade, you can skip this step and go straight to step 2. For GDX, the put option will expire worthless. It's only worth a penny, so we only need to buy to close the December 6th $28 call option, and then we can roll over the position into the December 13 28.50 call and buy to open the 27.50 put. Okay, so that's our trade alert for today. Let me take a look at the top news. And real quick, let's just review our open positions and the P&L on this current trade. So the TLT started off with a loss on Monday. It jumped to a huge profit on Tuesday. It was down on Wednesday. It opened down this morning, and then it's been going up all morning from the impeachment inquiry. So we did have a 93-cent loss week over week on the TLT. Our patience is going to pay off. This is one position I have high confidence in for the next 2 years, and that's because the Fed's planning how to drop rates to 0 and then what to do once they get to 0. That means TLT has another $40 to travel higher at a minimum as they slowly but gradually lower these interest rates. And we have a webinar coming up in an hour where I will explain this in great detail for you as to why the Fed really has no choice but to slowly lower interest rates and how that will drag the TLT substantially higher. And this is regardless of a trade war or not. GDX delivered a 53-cent profit per share. So that did offset over half of the losses on the TLT, trading from 27.01 to 27.71 when we closed out the trade. And we gave up some of those profits for the protection. 7 cents to open the trade and another 10 cents to close the trade. The SPY position is up 3 cents at current. This was a very tight option caller where we profit from the SPY traveling flat, and we have tremendous downside protection. Again, I do think there's a high risk of a sell-off in equities to close out December. I would be highly surprised if we get past the 315 price tag on the SPY, which I predicted right after the phase 1 trade deal came out. The only way it goes back to 315 to close out the year and potentially way above that is with the phase 1 trade deal. Everything else is really starting to crumble in terms of economic data. Emerging markets were currently short by selling an in-the-money call and buying an in-the-money put. We're down 17 cents a share on this currently. But again, we're getting towards the fireworks. I don't want to be betting up on a trade deal at this point in time. It was a very tight inverted option caller. Let's take a look at the top news. Okay, so equity futures jump on, you guessed it, increased hope of a trade deal. This is almost becoming comical. We need a massive investigation into Chinese delegation of the World Bank and how they became the managing director, the treasurer of all 5 entities, the head of HR, and even the head of ethics. We have a CCP, Communist Party, member as the head of ethics for the World Bank. And what Chuck Grassley means here is that the Chinese CPF being held today at World Bank Board isn't on their website, the 200-page document isn't posted, and no one has read it. Inside the document, it says the World Bank is going to continue lending $1.5 billion US dollars per year to China. Now, this is what is been going on live all morning. We had Senate interviewing the Treasury Mnuchin, and he was pointing out why on earth is the World Bank loaning money to China as if it's a small developing country. And you can see they've taken control of it. Global Times opinion, a Chinese senior economist, China should be prepared that the trade war, from irrational confrontation to rational cooperation, could last all the way to 2035. So President Xi's goal is to become the leader of the world in terms of China being the powerhouse. They have been the leader for much of the last 3,000 years, and they're saying the last 100 years were just bad luck. So anything that the U.S. wants to push towards China that doesn't fall in line with China becoming number one is not going to be supported. And unfortunately, a great deal of what the U.S. is pushing with this trade deal goes directly into that. Also, if China were to purchase $50 billion of agricultural products from the U.S., that would represent about 40% of their total agricultural purchases last year. And that means they're going to have to cut off deals from a lot of their core trading partners. So I don't think they have any interest in doing that. Chinese Commerce Ministry said Thursday that if China and the U.S. reach a Phase 1 trade agreement, the tariff should be reduced, adding that both sides are maintaining close communication. Now, this is different wording, and we got to pay close attention to that. Last week, they were saying all tariffs rolled back for any trade deal. Now they're saying some tariffs rolled back. So they're playing with the language there. Very important. I argue that if we decoupled from China completely, it would cost us 2% of GDP. The good news is that they steal 2% of GDP from U.S. each year and earn a positive return on the theft annually. So it'll be a net positive for us to walk away. Trump likes to play the role of great decider on China trade talks, like it all depends on him. The decision he'll have to make is how bad of a deal is he willing to swallow, since the Chinese will never give him much of any real value. The contradictory statements by U.S. officials over the Phase 1 trade deal might just be Washington testing the waters. Trade talks remain on track. China, U.S. in close contact for a trade deal. If there is a Phase 1 trade deal, tariffs should be rolled back accordingly. China will push forward the development of its derivatives market and will introduce more stock futures, interest rate futures, forex futures, and more options. So they're talking about opening up their currency primarily, as well as their stock market, which I believe would cause the yuan to severely devalue against the dollar. So if you're in our boot camp program, we're getting very close to putting out our first trade to short CNH. It makes sense to wait for the December 15th tariff to see what outcome occurs. Part of that deal was supposedly forcing Chinese to maintain a strong conversion rate of the yuan against the dollar, which is costing them a fortune. They've lost 25% of their foreign reserves in the last 2 years since this trade war has begun. And Hong Kong has lost 80% of its reserves, which are pegged to the dollar. So they're running out of cash quickly. I have verified that in response to U.S. restrictions on Chinese diplomats, China requests U.S. diplomats in China submit a written notice 5 working days in advance before their formal meeting with Chinese local government officials. So we're just seeing that the two countries are slowly but surely decoupling. China has no timetable for reaching a trade deal, and trade talks should be based on equality and mutual respect. So President Xi will only sign a deal that looks like he wins. And Trump only wants to sign a deal that looks like he wins. This is looking highly unlikely to be resolved in the next 10 days, which leads me to believe we will see tariffs go up on the 15th in 10 days. Back-to-back records, China corporate bond defaults climb toward all-time high. Okay, so we have emerging markets bidding today while they're having banks and construction companies primarily default on their debt. This does not make sense. Trump's trade optimism wanes amid declining soybean exports. Odd calm in China markets has traders suspecting state support. Mitch McConnell is constantly criticized for marrying a Chinese lady who's father is highly connected to the CCP. A lot of photographs have been taken of his wife meeting with communist leaders across over in Hong Kong. So there's a lot of buzz about this. However, he continues to support the Hong Kong movement, and I haven't really seen anything he's publicly said against the China trade war to back up these claims. I'm proud of the Senate's latest action to support the Hong Kong, and I'm proud to have stood alongside Hong Kongers for decades in their fight for true self-determination. The long view, is this a real slowdown or just worrywurst? We'll know in a few months. In this chart, he's showing ISM non-manufacturing and ISM manufacturing diverging here. And so last time we had a major divergence was back in 2015, and you can see the ISM manufacturing was able to drag the non-manufacturing with it. So this is pointing that we may have some slowdown ahead. Corporate credit, CLOs, are a major financing vehicle for lower quality U.S. credits. They buy lower quality assets, but if they keep turning into total junk, CCC rated, the market may be unable to digest. Most CLOs can only hold 7.5%. Most are close to maxing out. Here's a look at the share of loans at the CCC rating, right above 7%. And this again was the loans that we saw spike to interest rates as high as 13% a few weeks ago. Typically, when you do have a crash, you see the smaller, riskier assets start to tank first and slowly work your way up the food chain. And this is just looking at different years of the percentage of loans that were rated at CCCs, and you can see it's never been above 6, so we're already at a record high in funds like HYG in terms of ETFs that we can easily trade. Nancy Pelosi, over the past few weeks, the American people have heard the testimony of truly patriotic career public servants, distinguished diplomats, and decorated war heroes. The facts presented are uncontested. The president has engaged in an abuse of power. The president's abuse of power undermined our national security and jeopardized the integrity of our elections. His actions are in defiance of both the vision of our founders and his own oath of office. The do-nothing radical left Democrats have just announced that they are going to seek to impeach me over nothing. They already gave up on the ridiculous Mueller stuff, and now they hang their hats on two totally appropriate, perfect phone calls with Ukrainian president. This will mean that beyond important and seldom used acts of impeachment will be used routinely to attack future presidents. That is not what our founders had in mind. The good thing is that the Republicans have never been more united. We will win. The timeline is the same as we have been reporting for weeks. Articles could be voted on next week in the House Judiciary and week after on the House floor, week of December 16th. Expect one more hearing in the House Judiciary next week when the House Intel attorneys present findings. They'll have to make a decision on the scope of the articles under consideration. Number 1, abuse of power and bribery. 2, obstruction of Congress. And 3, obstruction of justice, including the Mueller evidence. And here we've got Andrew Yang, who wants to give everyone $1,000 a month, spraying whipped cream into the mouths of his fans at one of his recent rallies. Let me pull up some charts for you guys here. Okay, so the big picture on the TLT is that if the TLT tanks, that means the long end of the Treasury is going higher. If that goes too high, that will cause money from the stock market to flee over to high-yielding 30-year, 10-year, 20-year Treasuries, and also cause a massive amount of money that's invested in bonds at these lower yields to be underwater on their bond portfolio. So we have seen plenty of sell-offs in the TLT, as you can see over the past 20 years. But in general, it's traveled higher and higher. And why is this the case? The case is because the federal funds rate has slowly but surely gone from very high levels, up around 8%, towards 0%. Currently, we're at 1.75 to 1.5. That means the Fed can cut rates, if they do it as slowly as possible, 25 basis points perhaps every 90 days. That gives us a relative timeline of about 2 years that the Fed can keep all this money loaded up in the bond market. If they do not continue to signal that there will not be rate hikes, if they do not continue to pump $60 billion a month into purchasing these treasuries, this would sell off immediately because there's too much bonds being issued at too low of a yield. So this is being artificially pushed higher and higher by design by the central bank. And they have no dialogue whatsoever about increasing rates right now. If you go listen to their latest FOMC meetings, all they're talking about is what should we do as we approach zero. Because if you're a bond buyer, which is primarily JP Morgan, all these huge banks are buying billions and billions of dollars of this asset. They want to be able to sell it for a profit, not to you or me, but back to the central bank. And so the big worry at the Fed is what do we do as we get to the effective lower bound? And so they're talking about really three things. Number one, the potential for negative interest rates and how well it's worked for Europe and Japan, which I'd argue that's a joke. Two, they're talking about capping the maximum yield on treasuries. So essentially that's exactly what Japan did to go into 30 years of negative returns in the stock market, and also to have the greatest public debt in the world relative to their GDP. So hopefully they don't take those actions, but that's exactly what they're talking about. And the third thing they're discussing is unlimited repo. Now remember, they did an emergency meeting 2 months ago and decided to launch quantitative easing. Now they're saying it's not quantitative easing because they're only supporting the front end of the treasury market right now. But the fact is that they've pumped more money into the bond market in the last 60 days than they ever have in history over the same period. More money than QE1, QE2, QE3, or QE4. So this trend is guaranteed for 2 quarters into 2020. They've committed to this asset purchase program. And I suspect if the trade tensions do escalate, which could happen in the next 10 days, that they may speed up the process of lowering interest rates, and they may also speed up the process of purchasing bonds to support the credit market. So all in all, we want to be long the TLT until we get closer to that effective lower bound. Then, depending on how the Fed's going to try to manage everyone wanting to sell their bonds at the top, we can decide if and when we want to short the TLT. The big picture is, over the past 200 years, the average federal funds rate, or the cost of money, is closer to 5%. So that is probably going to be overshot in the next recession as soon as inflation forces their hand. Let's take a look at the big picture on GDX. So typically the Fed will wait to do quantitative easing until after assets have crashed and bond prices have appreciated. So, the standard strategy here is let the banks load up on the bonds, cut the interest rates. The banks make a gigantic profit from bonds going up. The Fed buys the bonds from the banks, which is what they did right here towards the bottom. And then the banks are in pure cash. So the banks get to have a huge profit from bonds appreciating and rates going towards zero, which is exactly what they did in the 2007-2008 crisis. And this crisis was caused by the banks, which is what makes this so ridiculous. And then after the banks get their bonds purchased for a massive profit, guess what? The banks go in there and buy up the stock market at pennies on the dollar. And so quantitative easing causes all these assets to go up. Well, this time around, they've cut the rates, and they're already doing quantitative easing at a faster pace than we did in 2009. And you can see what happened to GDX. The last time we did massive quantitative easing, it skyrocketed to 65. Now, this was primarily from the U.S. housing bubble popping. A lot of malinvestment from banks loaning money to people who had no business buying a house. This time around, the slowdown is from China's housing bubble beginning to collapse. The amount of misallocated capital is much worse this time around, probably at least 10 times. So the amount of quantitative easing that's most likely in our near future will be much greater than we've seen in the 2009 through 2011 quantitative easing period. So that's our look at GDX. My expectation is this can go well above 65, and we just need to be patient and let these central banks do what they love to do, and that's cut interest rates and print a whole bunch of money. Let's take a look at the SPY next. So the last time we had a financial crisis, they were able to cut rates by about 5%. Starting in 2007. So the Fed's actually quite accurate at predicting a recession before it happens. They just don't want to freak out the world and tell us that's coming. So in the last crisis, they were cutting rates into the crash, which again generated massive profit for banks who are long bonds. As those yields go lower, the value of the bond goes up, and then once the market had crashed enough, they turned around, the central banks bought the bonds off the hands of the banks for massive profits, and now the banks were in pure cash. What did the banks do? They bought up all these assets at a significant discount. And they've been doing QE on and off pretty much for the last 10 years. So they've tried to hike rates into 2018, and what did we get? We got a very nasty crash, which forced the Fed to switch gears and go back to lowering interest rates and printing money. The problem is we're almost at zero, so their ammunition to continue goosing these markets higher is coming towards an end, unless they want to go to negative interest rates. So that's the big picture on the SPY. With a trade deal, I suspect SPY goes up to around 330. Without a trade deal, we got to realize we're still in quantitative easing. And until the credit markets crack, the corporations can borrow at cheap and buy back their own stock. So let's say we do get a trade deal that breaks down December 15th. Does that mean we suspect we'll have a one-year bear market in equities? Probably not. Rates are at zero. This will mean that corporations will continue to borrow for cheaper than they ever have before, cheaper than they did all year, and continue to buy back their own stocks. Now, I'm sure insiders will be selling left and right as their corporation buys their own shares back, but my expectation is a short-term sell-off, potentially as long as 3 months. So that's what I'm expecting on the SPY, is that we're headed towards a sell-off because trade talks break down. But all this will do is push the Fed to lower rates quicker and make corporate credit cheaper. So what will end the party? Of course, inflation. Let's take a look at emerging markets now. So emerging markets is primarily China, India, Russia, South Korea. And we can see it's really gone nowhere for the better part of the last decade. A lot of people like Ray Dalio, Jeffrey Gundlach have been betting big on emerging markets. My expectation is the emerging markets and SPY will fall together for most likely 2 to 3 months at most, with the first news of trade deal breaking down. But because we're in this low interest rate world, I don't want to be short equities for a long period of time until interest rates are heading higher. And that's when you can actually get a more long-term bear market. The next chart I'd like to look at is LQD. LQD is your investment grade corporate bond fund, and the higher this goes, the cheaper credit is for companies like Microsoft, Apple, Amazon, Google, AT&T, all the big dogs, to be able to borrow money and flip it into corporate buybacks, which is what they've done at record pace, especially for the last few years. And so until this chart is really selling off, the top companies in the SPY ETF are going to be able to get cheap capital to support their stock. And Microsoft's actually getting negative yielding debt in Europe. So imagine that. Microsoft can get paid to borrow money to go buy back their own stock. It's going to be very hard to get a long-term sell-off when LQD is at all-time highs. So most likely, this ETF will crash well before LQD and give us a bit of a heads up. This is your high-yield corporate bond ETF, your junk bond ETF. This one has a large position in those CCC bonds, which have been, the rates have been spiking recently, signaling there is trouble ahead. And don't forget, we have this repo market, also signaling the banks are having liquidity problems, probably from so much corporate debt, probably from emerging markets whose currencies have devalued, and their debt, which is denominated in dollars, is becoming harder and harder to service. And so we can see the chart for HYG does not look nearly as healthy as LQD. So this is certainly a warning sign, and if we do see this chart crash like you did in 2018, that would definitely be a warning signal for us that there's trouble ahead. Okay, so that's a look at the top charts. Let me close this out with a little PowerPoint about our program. And again, we do have a live webinar coming up in an hour and 10 minutes. You'll get a link in your inbox every day, an hour before the webinar. And starting tomorrow, we'll be having daily webinars instead of this YouTube live stream, which means I can open up your microphone for questions. Daily income trade alerts at noon Eastern. Trading plan, 100 shares of the SPY traded Monday, Wednesday, Friday, taking advantage of 3 option expirations. Emerging markets traded on Tuesday with 200 shares. The TLT and GDX are traded on Thursday with 200 shares each. This gives us a relative value of 50% of our portfolio in equities, 40% in bonds, and 10% in gold. Our target income is $750 per month per $75,000 invested, or 1% per month. Our average return has been 1.3% per month over the last 12 months. We've had profits in 11 of the past 12 months, and our largest drawdown in a single month is negative 1%. We've never lost capital over a 90-day period, and our portfolio really stands out when the S&P 500 sells off. That's because our put options kick in on the SPY, and the TLT delivers a big gain. So in December, when the market sold off 18%, we delivered a 1% return. In May, when the market sold off 7%, we delivered a 2.2% return. And in August, when the tariff threat that we're now reaching was announced, we delivered a 0.8% return when the S&P 500 returned 6% loss. We have 3 basic strategies during the current environment. If we have an escalating trade war, we'll use the options to create a profit from SPY and emerging markets traveling lower. So note the negative sign next to those assets. And in this situation, we'd expect the TLT and GDX to travel higher. So my expectation is that within the next 10 days, we will be in an escalating trade war. If we have a de-escalation, we want to short the TLT and GDX for a short period of time and be long SPY in emerging markets. That's what we had from the phase 1 deal in October. And if the trade war is up in the air and we have low rates, low inflation, and quantitative easing, that's a bubble. Everything goes up, and that's where we're long the SPY emerging markets TLT and just tight on GDX. GDX really travels up when there's panic. This is a review of our 3 option callers. We have the bullish loose option caller. If we sell an out-of-the-money call and buy an out-of-the-money put, expect the underlying asset to generate profits by traveling higher, and your options will lose money. That's the design of that trade. In a neutral, tight option caller, we profit from the asset just going flat. That's what we have on the SPY right now. It allows us to collect a very juicy premium by selling an at-the-money call, and then we turn around and use part of that income to purchase a near-the-money put. So if we think we're near the top from a big move up and that it may just sit up at a high level until it tanks, this is a great trade setup, which is why we have it on the SPY right now. And finally, we have the bearish inverted option caller. We sell the in-the-money call option and buy the in-the-money put, and this ends up in a situation where you own the asset, you're leasing it out to a call option buyer for a huge premium, in this example $219, but you're going to turn around and buy an even more expensive put, and this allows you to generate a total profit from your asset traveling lower. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Our goal is to generate income and safety, not growth or speculation. Simplify your holdings, reduce your risk, get better results with less work, and weather-proof your retirement portfolio. Call Dean now to lock in your discount and a free month in our $10,000 bootcamp when you upgrade your free trial today. Call him now at 505-322-7515. Here's our disclaimer. If you want to pause that and read it or visit the link, please do. Otherwise, give Dean a call right now. Let's get you set up to profit from volatility to close out the year. 505-322-7515.